So where to begin? This has been a very interesting market. My concentration on this panel has to do more with the pipe market. We haven't seen a lot of de-SPAC pipes happen lately. There was a point not long ago, a couple of years now, maybe it's a little long ago, where we couldn't keep up with the amount of deals that are getting done. But why don't we talk a little bit about, before we get to the de-SPAC pipes, what are you guys seeing in terms of the future and how's it going? So we can get into it and I can give my perspective on the pipe part as well. Any order. Oh, they can hear.
Yeah. So it's remarkable that people are congratulating themselves that redemptions are 93%, not 99%. So I think talking about the future of SPACs is a little premature without addressing some of the fundamentals that are driving that and the low amount of legitimate fundamental pipes that are happening. Not to be negative, but I think there's still a ways to go in terms of some of the things that we just heard about: pricing discipline and setting appropriate valuations and getting fundamental investors involved earlier in the process. So just wanted to start off with maybe a more grounded sort of statement before we start patting ourselves on the back quite yet.
Yeah.
So the fact we're at the biggest year since 2021, not quite there. You're not excited yet.
No, I think we're a long way away from that still. I think you go back even before the SPAC boom to the 17, 18, 19 environment when you did see some very fundamentally oriented pipes and that sort of thing. We're nowhere close to that right now. Anybody who looks at what's going on in the SPAC market, the resurgence we've had, everything else, all of that activity has kind of come on the front end and with deal announcements. We've kind of yet to see with the current resurgence what the back end looks like. Many of the deals are obviously trading above trust, which is a positive signal. But many of the deals still don't have pipe announcements, still don't have redemptions, votes yet, or a complete de-SPAC process. So, it is certainly more positive than what we've experienced over the last 2 or 3 years, but I think we're a long way from a stable environment for SPACs.
Yeah, I do think it's important, though, to keep in mind, the composition of the current SPACs. You do have over 80 SPACs that are over 36 months of age. And on the opposite end of the spectrum, you have a number of SPACs over 40 now that are younger than 12 months. And so neither of those cohorts of SPACs is really in a position to be announcing just yet. So there is still sort of, I think, room for hope that we do see some exciting companies come public via the SPAC product. As far as redemptions, I agree with you; they're still very high, but you do need to consider that the ones that are closing right now are the very, very old SPACs that have already seen their trusts whittled down to, with 90% redemptions. And so they are sort of affecting the average, let's call it.
Meaning you would expect that the older ones will just continue to fade away at this point?
Fade away. Well, some of them, we still have 22 SPACs from 2021 out searching for deals, if you could believe it. I know Mitch brought up earlier, the 36-month rule, which may be a factor, but a lot of these have been sort of grandfathered into that. And do I think they will close a deal? I think they hope they will, but I think the vast majority of people working on this within the SPAC ecosystem, I think they don't have a ton of, let's call it hope for a good deal to come public.
So you don't think that even the old ones can get into the Bitcoin game at this point? Does that really matter?
I mean, listen, there's always the exception, right? And I always go back to, there was a company, or a SPAC, I should say, that was called Easterly back from, I think they IPO'd in 2016. And at the time, they were the oldest SPAC by a country mile. They had gone 42 months. They had terminated 3 deals. And they finally closed a deal, and it was a good deal at the time. They closed with a company called Sirius. So it can happen, right? But the point being, Easterly still had a sizable trust. I think they had 30 or 40 million left. the vast majority of the zombie SPACs right now have less than 10 million and sometimes less than 5.
And maybe just to be a little more bullish, I mean, I think as we wave or phase out of the older SPACs, the newer ones, as they get better deals done, I think we will start seeing better pipes. If they trade better, the liquidity is better, they're actually operating businesses that have better financial profile, we will start seeing pipes come back. So we're at least a little more bullish. I think there will be cleaning up of the old SPAC market that a lot of them are on OTCs. It's just going to be hard for those to get attractive pipes. But we're seeing better deals get done. We're seeing better term sheets get presented, still structured, some fundamental, some not, but at least better than what we were seeing maybe a couple of years ago.
So I'm just curious, because we've talked about the prior introductions, talked about the fact that there's a bunch of SPACs getting done. We're talking about the zombie ones going away, the new ones there. What do you think is driving the desire for new ones to come to the market? What's different about it today than what's happened over the prior years that's driving this volume? And what do you also see, because you're the ones who are playing the most in this, what do you see the future of them doing? Is it just going to be Bitcoin? What are they looking for? What's getting this all to come together with an increase in the SPAC deals at the same point? What are they going to do to de-SPAC?
Yeah, I'm happy to take the first crack at it. I think that, as Mitch was talking about and Gary touched on, there's a massive IPO backlog in all of these companies, whether it's long in the tooth private equity owned assets or otherwise, are looking for liquidity events, access to the public markets, however you like to describe it. And so I think when you look at a lot of the repeat sponsors that have come back, or maybe even some of the more sophisticated first-time sponsors that are in the market over the last few months with an IPO, you have to be in the market to be able to act on something when it's ready. You can't be waiting until there's a whole bunch of IPO activity and then decide to raise a SPAC and try to catch one of the tail ends of the wave. And I think that's what you saw happen in 2021 when there was over 600 SPAC IPOs. It was just too many entrants too late in the cycle of the market. So I think a lot of these repeat sponsors are looking at it saying, hey, we've got access to these deals. We know that the market should be heating up again. Maybe it's on the back of the new administration or whatever the case may be. But you've got to be teed up, ready to go. You can't get a SPAC stood up overnight. So it takes you that 3 or 4 months. You want to have your vehicle in the market and start making calls before things start to heat up. And I think that's what people are, SPAC sponsors are doing in anticipation of what deal activity might come. I don't think it's a coincidence that after the Trump administration won the election in November is when you started to see the pickup in activity, because the assumption is that capital markets activity will pick up on the back of that.
But have we seen that? Just talking from the M&A experience, we were expecting, the whole market was expecting an explosion of activity, capital markets, but core M&A. We haven't seen that yet, and maybe it will still happen. So is the thought that this is just the gearing up for the hope that will come because you can't just do it overnight? Is it because they're expecting PE for looking for exits that they're not getting to traditional M&A markets? What do you think is happening, and what's different? Are the players different because of the things we're talking about?
Ellie, you know better than anybody here that there's a lead time on document development that.
I do them overnight, so I don't know what that means.
It just comes off the shelf. You just edit it up, right? So, no, but the thing that the statistic I quote to half the people in this room is that between roughly 2006 and 2018, the average redemption for SPACs annually was about 50%. That's a normalized market. What happened during COVID, when the average redemption rate was down below 20%, is unfortunately as far back as many people's memory go. So whether it's an experienced repeat sponsor or a new sponsor, many of whom of the new sponsors are being drawn into the market by what Mitch talked about, which is a really reduced pricing barrier to entry. It's much less expensive for a new sponsor to enter the market now, which raises the burden of pricing discipline. So the thing that people are continuing to be drawn to the SPACs is the certainty that an issuer will be a public company at the end of it. If they really want to be public, they need to select a SPAC. That's really their best option as a target company. But until we have pricing discipline and we see stocks trade fundamentally well, not the result of a short squeeze, but trade fundamentally well. The list that Gary put up of the top trading SPACs unfortunately had very, very high redemption rates, and you can argue that they were fundamentally supported by strategic investors or there was a limited supply. So we still, those of us here who are practitioners and the people in the audience who are managing these transactions need to be vigilant about maintaining the quality of how we price and execute these deals. And all the points that Mitch talked about, the technical issues of round lots and liquidity and meeting NASDAQ requirements, planning ahead of time, finding targets and sponsors that can agree on rational pricing to give certainty. I think it comes back to what do we see? It's not going to be instant. We're going to see a slow buildup, and hopefully we return to the quality that Joe's talking about, which are pre-COVID that we saw.
So let me play contrarian for a second. So all this thing seems very aspirational. We have now these new SPACs coming to market. We're talking about maybe better quality of sponsors. We're talking about pricing discipline is a necessity. We're talking about, Mitch put up a statistic. I think he said there's only 19 non-SPAC IPOs this year, if I remember his statistic. So there's not a lot of ways to exit in the markets right now into the traditional IPO market. All that stuff makes a lot of sense. So what I'm hearing is, so there must be this tremendous onslaught of de-SPACs going on, but I'm not seeing that. So where's the disconnect? What's going on? What are we seeing? And what do we think the future and what's going to change that?
I do think it is actually going on. You just haven't seen it yet, right? You have to keep in mind that a lot of the serial sponsors that we've seen come to the market, they started coming back to the market last June, right? So we're hitting that critical 12-month mark right now, right? Which is typically when you start to see deals announced. So there is a lot of hope that we will start to see deal announcements pick up. The good news, and I think that gets lost sometimes, is the IPOs we've seen in 2025 and in late 2024 all came from serial sponsors that have been battle tested, right? They have been through a very difficult market. Hopefully they have learned something from it. The other thing, too, is if you talk to a lot of the bankers and lawyers, they will tell you that inquiries for the SPAC product have definitely picked up. They are seeing better quality companies. So those are all positives, but you're right. We have yet to see it play out, right? So there always is a little bit of PTSD there, I think. Everybody's hoping for the best, but we have seen the worst before.
And just to add to that, I mean, we're talking to a lot of VCs that previously probably never entertained letting their portfolio companies merge into a SPAC. Now they've been in the fund or investment for 8 years, 9 years. They were hoping the markets would turn around. At some point, they start exploring a sale option, and M&A is still pretty dead. So they are actually entertaining a lot of SPAC discussions. So we're seeing that. We're going to see the same with private equity shops. The other thing we're seeing is, SPAC generally, a lot of the targets are below the $1 billion market cap with exchange rule changes and getting tougher, and you need to raise a certain amount of capital. The cap stack needs to be distributed in a certain way. We're seeing a lot of issuers now come back and say, is SPAC a better path for us versus an RTO or direct listing? So we're seeing that pivot towards SPAC. And then also internationally, a lot of issuers, Asia, Middle East, that are now exploring public markets in the US, dual listing, and they're all looking at SPACs as options because they know the regular way IPO is still pretty tough. There's a backlog. You're going to be back in the role play, and still it's hard to get public, and you're spending a year long, and you may not go public. Versus SPAC, you still have a valuation agreed on. You could do a structured pipe. Maybe there's fundamental investors they could bring from their part of the world. That could be better structured pipes.
That's what we talk to people about, is the certainty of it. If you're a fund and you absolutely have to have a liquidity event, if you've got a security on your cap table that's going to explode and you need the absolute assuredness that you're going to be public, the SPAC is really the only option that you can use. And so if properly executed, it's absolutely essential.
Personally, I'm curious about one thing, because we talk about it, I agree with all the things you're saying. What I'm wondering is what is the holdup from the logic of what we're saying? IPO market's dead, M&A market's dead, venture capital, PEs has much longer times that they're in the investments they didn't intend. They're looking for exits. The match is there. It's staring you in the face. You're saying, and I hear it, that maybe we're going to see. It sounds like June, July
Yeah,
may be very busy.
listen, the first quarter was tough. Tariffs definitely
Right.
threw a few monkey wrenches into things. So I think what you're asking is why haven't we seen it yet? Listen, the IPO market, the traditional IPO market, is for sure open now. Thanks to the success of Chime, Circle, which is former SPAC target company. And a rising tide does lift all boats. I mean, people talk about how the SPAC market performs very, very well when the traditional IPO window is shut. That's true, right? But the SPAC market performs really, really well when both windows are open, right? Because that is just a signal that risk is back on. And so I do think now that we are past a lot of the tariff noise, I mean, it's still there, but it seems like the capital markets are ignoring it at this point. I do think you will start to see that pick up.
And I would
Yeah,
say
I
like
think-
the SPAC.
No, go ahead.
Go ahead. I was just going to add, I mean, the SPAC frenzy I would almost call over the last month or 5 weeks has been much more than the first half of the year. So it will take time, it will happen, but I think the last month has seen more record number of SPACs.
And what do you think that's showing us?
I guess it is just a combination of everything we talked about. IPO markets shut down, repeat sponsors realizing having a vehicle to merge with the high quality targets a lot easier. Valuations went down when the markets tanked with tariffs. Getting a deal done now and then reaping the benefits when valuations get better back half is the other upside for sponsors. So we'll see all that play out. I just think we got to give it time because all these things, getting public, starting the target search process takes months. So we'll see that probably back half of the year or the next year.
I do think, SPACs are still struggling against, the reputation of the past couple of years, though. That is definitely a headwind, and it is still difficult for sponsors to talk to companies. But, listen, SPACs have had worse things they've had to get over, right? If you have been around the SPAC market for forever, and you talk to some of the sponsors, they will tell you that it's still easier now than it was prior to 2016 because at least people understand what a SPAC is now.
Yeah, just to build on that,
Go ahead.
I mean, I did my first SPAC as a sponsor in 2017. In the first meeting with any target company or the stakeholders was explaining what a SPAC was and why it made sense. Now I think it's the total opposite, where it's like you're explaining why a SPAC makes sense because it's been a 4-letter word for the last 3 or 4 years. And I do think it makes sense, to Guy's point and everything else, for certain companies and certain situations and so on and so forth. And, now you just kind of have to build from, the wrong side a little bit to get people to that point. So I think to your question, whether it's a private equity sponsor, VC fund, whoever it is sitting here saying, all these SPACs have underperformed. Why do I want to take that risk and be an underperforming asset as well? So I think it's going to take getting through some of these higher quality deals that we were all talking about that have been announced over the last few months to see how those work out from a pipe standpoint, how they get to closing, what that process is like, what the redemptions are like. So I actually don't think that you're necessarily going to see significant positive momentum on the back end of SPACs until probably the end of 25 or into Q1 of 26.
And remember, what drives that is the supply of appropriate public-ready companies, which is relatively independent from the supply of SPAC sponsors. So if you're using as a metric liquidations or the number, there's a 30-year downward trend in the number of companies accessing the public equity markets. So there's this huge supply of private capital that is being competed against. So, yeah, there's not going to be an explosion of back-end success. It's going to be much more driven by the fundamental economics of companies that are ready to be public, that need to be public, and we have a sufficient supply of high quality sponsors in the market now to satisfy.
If you look at things like, aside from a few standout transactions over the last 3 or 4 years, the last time you saw that, high quality SPAC target and fundamental investors paying attention and everybody racing to be a part of it was when everybody had nothing else to do during a pandemic, right? So everybody was willing to pay super high valuations and whatever else. And, respectfully to all those companies that did de-SPAC then, it's the ones that are truly, have underlying fundamentals, operational performance, good financial metrics, strong cap structures, all of that sort of thing, that are the ones that have continued to perform and, have done well. But I think there was a lot of noise back then because everybody was just looking for the next high-flying deal. And 2 quarters after they de-SPAC'd, they didn't come close to the numbers that they had in their projections and their S4 and everything else, and it just created a difficult environment. So I think we're rebuilding that, but to Guy's point, it's the underlying fundamentals of good quality targets that are going to lead us there. So if you can get some of those, if you can get half a dozen, it doesn't even have to be a crazy number, high quality targets who decide to exit via SPAC, I think it changes the game. But I think everything Mitch said is exceptionally true, in that you've got to be mindful about valuation structure, all of those things that matter to create a positive transaction outcome, as opposed to just trying to go and do a deal at a $5 billion valuation for a company that's done 20 million of lifetime revenue.
Yeah, I think it's a case of show me, don't tell me, which if you remember prior to the boom of 2021 and in March and April of 2020, right, we saw DraftKings go public. At the time, if you remember, when they announced the Virgin Galactic deal, right, be it that as it may, how it's performed now, but at the time it was a very exciting deal, right? And both of those closed. They performed well when they did close. And so that was a case of, people had started to hear a little bit more about the SPAC, but you needed that DraftKings deal. You needed, I think at the time, Nikola, unfortunately, but, listen, at the time it was an exciting deal, right? And so it did close, and finally the SPAC market had something to point to, right? And said, you can look at this deal, right? So we have yet to see that in this current environment, but when it does come, I agree with you, it should kick off some momentum.
One thing I'd add is, there's 2 models of SPACs now, right? So the traditional, where sponsors brought in all the risk capital, great, sponsors had the money, these investors came in for the free yield, and they redeemed. Now these investors are actually taking equity risk. So these syndicate structures, their cost base is maybe $1 or $2, but they're actually taking equity risk. So when we get on these calls with investors, the same yield players, they actually drill the sponsors. What's your strategy? What's your track record? Why do you think you'll get a deal done? Why do you think you'll get a good deal done? You're not seeing those dialogues. These dialogues were never had previously, but now all the calls you get on for syndicate deals, it's the same conversation. So that has obviously improved the quality of sponsors. With just better quality, you'll see better quality deals. And these guys are taking equity risk. So when the pipe comes in, they'll be a little more open to doing less structured pipe, more equity type play. So we feel like the syndicate actually will help improve the overall asset class as well.
The one thing I see representing investors, there's no question that I'm seeing the same thing. They're willing and they're doing pipes when they come up. And earlier on, they're being offered parts of the sponsorship deal, and they're investing in that in a more robust way, something we haven't seen for a while. So clearly the appetite's there. That has to mean something. It translates into more SPACs coming out. We're seeing that. It sounds like we're seeing higher quality sponsors and a higher quality sponsorship syndicate that's bringing it to market. What is still the disconnect, and I hear all the things, is where are we going to see the back end? I know the 12-month cycle, we're getting to that. You're saying it's more the end of the year, beginning of 2026. Something has to catalyze it, and I don't think there's any question that it's not the SPAC market per se. We're seeing this in the M&A market, we're seeing in the IPO market, where the opens close a little bit. There's pent-up demand and desire, but whatever's going on in the economies generally, global issues, has held things back tremendously.
I think generally it's a bid from fundamental investors at the end of the day, right? Whether it's regular way IPOs or anything else, that's what's needs to happen. Because if you sit here and look at a SPAC pipe, and I don't know what the statistic is, but let's say that the average SPAC pipe is being done at $5 or $6 net effective a share. Well, guess what? Your valuation is just cut in half on whatever your headline deal is. So any fundamental who looks at it and says, oh, you have a pipe, I don't care if it's a $500 million pipe, but if it's at $5 a share and your deal struck at $1 billion, well, all of these investors only see $500 million of value here, right? So I think until deals are right priced and you start to get that fundamental bid back where people are saying, hey, I will go and buy $10 common equity in this deal at whatever the value is that you've struck, it's kind of the same thing as building an IPO book to some extent, which is to say if you go out with a price range of 20 to 22, but investors are only buying it at 16, it's not there.
Joe, it's totally accurate and reflects what one of the things Mitch Nussbaum was saying at the end is this $10 metric.
Right.
And I'm going to say the opposite of what I just said about redemptions. So if you go out with a standard IPO, if any company is going to price an IPO and the feedback from the market is, I'm a 10% order at $5, I'm a 0 order at $10, then it's a $5 stock. And what the SPAC allows you to do, which gets lost in the statistics, is reprice. You get 100% redemption, but you do a substantial pipe that meets the company's capital requirements needs, and it's priced at $2 a share for $10. It looks like the company went from 10 to 5, but it's repricing the IPO of that company. So that's a very sophisticated, subtle difference that journalists aren't going to pick up, that the media is not going to pick up, and retail investors, like the COVID investors, are certainly not going to pick up. But it's a sophisticated institution where a fundamental investor who values that $5 stock instead of 10 will get it. And there's been many really successful launches that had high redemptions and went on to have a good life. So I think, again, there's some fine-tuning of the metric here. Doesn't mean it's not a good product. It means it was mispriced at $10. Maybe there's a creative way to make that easier to perceive in the market, but it's still a great product for a company that needs to be public and gives you the flexibility at the end.
But would you expect, the more modern ones, we're going to put aside the ones that are, I'm calling running off, the older ones.
Yeah.
Why are you seeing or expecting to see more than just pricing right as opposed to what you're talking about to reprice it?
Look, I'm old school. I'd prefer that the bankers and the accountants and the lawyers and the target companies and the sponsor price it right. So that it trades up from 10. And the reason that you want that is because everybody's lost the magic of the warrant. The warrant is what made this product go back in the early 2000s. It allowed the market option value to really create tremendous wealth for people who bought in the IPO and held on to their warrants. So my hope is that there will be pricing discipline and people will price. Targets will accept pricing at a discount to their long-term trading value, like Joe was talking about. That would be my hope. Whether that takes place or not, only the future.
If you think about going back to a regular way IPO, right? You don't price it at the market. You price it at a discount to where the comps trade so that it trades up on a fully distributed, fully diluted basis.
Exactly.
You have to do the same thing with the SPAC transaction, right? And if you're sitting there saying you're at the comps, or even if you're at a discount, but the market's telling you for XYZ reason the target company needs more of a discount or whatever the case may be when you go to raise a pipe, you have to listen because that's ultimately who's going to determine the value of your deal. It's not you as the sponsor, it's not you as the target company, it's the market, it's the public market that's going to determine what the value is at the end of the day.
Maybe one thing to add is, the new variation we're seeing in SPACs, which is not good for any of the underwriters here, is the old SPACs had all this back-end fees, right? 3.5%, 4.5%. It kind of deterred a lot of the targets. You have no money left in the trust. There's no good pipe. I'm going to basically be stuck with the liabilities and now have to raise follow-on capital. Now a lot of that overhang is over. It gives sponsors a better chance to raise a pipe, get some cash to the targets. You're seeing better quality targets come up and be open at combining with the SPAC because you don't have the same overhang. So that's another variation that we've seen from the SPACs in 21 to now. A lot of them have no back-end fees or back-end fees tied to what's in trust, so you don't have the overhang. So that's another reason I think you'll see better ones get to market, and maybe they'll be open to like better valuation.
So just, I guess we're finishing up on time. I don't know, just to give some hopes or expectations of the next 6 to 12 months, I'm seeing from the investor side appetite and willingness to deploy and starting to see the deployment of the capital. So that's an encouraging sign because usually investors are only going to deploy when they see ability to monetize that in the back end. So that's my expectation and I hope it continues. I don't know anyone else?
I mean, we're bullish. We're sponsoring the SPAC conference, so we hope it keeps going. The dance doesn't stop, and I think, listen, it's maturing. We'll see better deals get done, and then, we'll see pipes come back. We'll see redemptions come back. We'll see it trade better. So, at least we're definitely bullish about it.
Yeah, I think it's a ripple effect, right? Good quality sponsors get good quality targets, which get good quality pipes, which get low redemptions, and brings the negativity or pushes the negativity away, from the SPAC market.
I would hope that appetite among the investors deploying, especially deploying to sponsor capital, ratchets up the quality of the sponsors. I would hope that that's true, because that'll lead to rational pricing, better market behavior, more discipline, and discipline to pass on deals that are not well priced, not at an appropriate discount to their long-term trading value.
Yeah, I mean, the thing I would like to leave it with is, year to date, SPACs have raised $11.3 billion, right? And that we're only halfway through the year. I do think the SPAC market kind of runs into a wall a little bit if we raise over $20 billion this year. It's just too much money. You're going to start to see competition. I will say also that the good quality sponsors, most of them, I would say the vast majority of them, already have a SPAC, right? And so the thing that we all have to sort of be cognizant of is the ones that do come public now, are we going to start to see lower quality teams, lower quality deals? That is a significant worry, but we'll have to wait and see.
Right, we're standing between the
Us and
entertainment
dinner, yeah.
So while we let them go, thank you all, and let's hope for a good year.
Thank you.